Wherever you are on your road to retirement, we're here to help you stay on course. Welcome to Mason Street Retirement Insights, the show dedicated to helping you plan your financial future.
What is your biggest concern? People are very focused on the amount of money that they have saved, but it's really about the income that we generate. Income is what's going to drive lifestyle. And so the income strategies that we utilize are what's key.
And now, here's your host, Sean Mason.
Welcome into Mason Street Retirement Insights. My name's Casey. I am alongside Sean every week here on the show as he helps us cut through the noise and make smarter, more confident decisions about our retirement. Sean, always great to see you. How are we doing this weekend?
Hey, Casey, we're doing great. Happy to be here.
We've got a lot I want to get into today. We're going to talk about some big changes that advisors are making right now. We're also going to talk about why emotions can really do the most damage right before or right after retirement. So we've got a lot of great discussion ahead. So before we kick things off, go ahead, do us a favor. Grab your phone, grab a pen, jot our phone number down, 559-847-0039. That's how you can reach us today. And you're going to want to do that because Sean has set aside a limited number of spots this week for his introductory retirement planning assessment. And he's doing this exclusively for our radio listeners. And he's doing it completely complimentary if you have $500,000 or more saved for retirement. So, Sean, I want you to talk to us about this assessment process a little bit. What can people expect, and why is this assessment such a valuable step for somebody nearing retirement to take?
Well, it's a good opportunity for people to come in and get some, maybe additional insight. If you are kind of questioning, not real sure about what your situation looks like, it might not be the best strategy to hope. It might not be the best strategy to just think things are going to work out. You live a different type of a life when you feel like you have clarity and certainty in that life is going to be what you expect it to be. It just it changes the way we feel. So you come in and we're going to have a discussion. We're going to talk through your situation. You have questions. We're going to answer those questions. And, we might have some recommendations that you can use to help put yourself in a better position. We might identify some things that we could do to actually implement strategy to help position you in a little bit better. So come in, have a discussion, and we'll just walk through it together.
That number, again, it's 559-847-0039. And I just want to reemphasize that this is a very low-pressure discovery conversation. This is just a chance to take a step back, look at what you have, and see if your plan is really built for the retirement that you want, and see just how Sean and his team can help you find that best path forward. So that number, one more time, it's 559-847-0039. Or you can always find us online. We are at MasonStreetRetirementInsights.com. You'll just click that contact tab at the top right, fill out your information, and then one of our Mason Street teammates will reach out directly to you. All right, Sean, let's get into some retirement talk, shall we?
Yeah, let's go.
Let's do it. So we talk a lot on this show about how retirement strategies evolve and how what made sense, 10 or 15 years ago might not be the best fit for retirees today. And that idea really stood out to me when I saw a new study this week that asked financial advisors if they are adjusting retirement plans for our current economy. Now, about 65% of advisors said yes, and many of them are using a strategy they've never used before, an annuity. So I'm wondering, Sean, if you can talk to us about what it is about the annuity that is appealing to retirees today, where it might not have been so appealing 10 years ago, because we know annuities have gotten a bad rap in the past. They've been a little controversial. So talk to us about what's changed here.
Yeah, it's a really good question. And, with advisory firms changing strategy, when we move or transition from working years into retirement years, everything changes. I should say everything except for the need for income, right? Because income is going to continually drive lifestyle. But the priorities change. And we have to recognize that the investment strategy that we use, the tax strategy that we use, they're all going to be dependent on the income strategy. And so investment strategy has to change based on priorities in retirement. But then, the current economic environment also matters. And so if you as an individual investor have the skill set to understand the economic environment and the data that goes along with it. You might make some changes. If you don't, you might be better off with just, sticking with a specific strategy and structure that'll help you through good and bad times.
So when we say annuities have evolved, what would you say is the biggest difference that retirees would actually notice today as opposed to how they were set up 10 years ago?
Yeah, that's a big one, especially right now. And the reason I say that is annuities are extremely interest rate sensitive. And so what I mean by that, depending on what we're using annuity for, we might be utilizing annuity for growth. We could be utilizing annuity for guaranteed income. The deal or the benefits that an annuity can deliver is going to be based on the interest rate environment at the time that you sign up or start the annuity. Mm-hmm. The higher the interest rate environment, the higher the interest rates are at the moment that you sign up for the annuity, the higher that guaranteed income can be for the rest of your life. The higher the growth opportunity can be for the rest of your life. The reason for that is the annuity company is actually buying a 10-year treasury bond as the foundation for those guarantees that they're offering. And recognize today, 10-year treasury bonds are paying 4%, whereas 5 or 6 years ago, treasury bonds were paying 1%. So there's a lot more they can do with 4% compared to 1%. We haven't seen interest rates like this in 40 years. We probably are not going to see them again in our lifetime. So if an annuity is something that's a benefit, it's something that you definitely want to start getting educated about now. But look, as is with any investment, an annuity might be a perfect solution for what you're trying to accomplish, but it might not have any fit in your plan whatsoever. So it really depends on what you're trying to accomplish and what your exact situation is. And then you also have to understand that there's different types of annuities. I was talking with Daryl and Marjorie a couple weeks ago, and Daryl's brother has an annuity, and he was saying that his brother just really doesn't like that annuity. And so he had a copy of it. He had brought a copy of it because he wanted to see if he couldn't help his brother with it. And I found that this was a variable annuity. There weren't extremely great investment options in that annuity available. Mm-hmm. Fees were, I believe they were right at 3% a year mm-hmm. for the fees. This annuity had been delivering about a 3.5% rate of return. It's real hard to get a rate of return out of an annuity when the investment options aren't great and you're paying 3%. Mm-hmm. So we started talking about a different type of annuity and started to try and fit and figure out if maybe annuity would benefit them in any way. Look, I was meeting with Johnny the other day, and he had come in and was really concerned that he didn't have a pension, and he thought that that was a real negative in his plan. Yeah. And so I showed him how we could actually take a portion of his resources and buy a pension. And he really liked that. And when we did the numbers, it really made sense for him. But then it wasn't just a guaranteed income annuity that was going to benefit him. We actually started working in his plan and designing strategy and figured out that some Roth conversions would be a significant benefit to him long term. And as we tried to enhance the benefits of those conversions, we found that a specific annuity designed for Roth conversions was going to increase the benefits significantly. So there's a lot of different types of annuities out there. Right now is really the timing that you want to go and start to figure out if there's a good fit somewhere in your plan for one of these annuities.
So this change in the annuity landscape that we've seen over the past decade, Sean, do you think it's more about the product itself changing, or is this about the retiree's mindset changing? Or maybe is it a combination of both of those things?
I'm finding, that's a really great question, because I'm finding more and more that people are probably more concerned about income and running out of money or running out of income to fulfill the lifestyle that they're looking for than anything else. Mm-hmm. And that's where annuities can really come in and make a big difference. I don't know. Maybe it's mindset. I don't know really what made that change, but 100% the interest rate environment is delivering much bigger income, guaranteed income for life than they were 5, 6, 8 years ago. And this is why I encourage you to come in and have a discussion and talk this out. What's good for one scenario or situation might not be good for another, and it just gives us an opportunity to come in. It gives us an opportunity to have a discussion to really talk through what you're trying to accomplish and what you're concerned about. So give us a call. The team is standing by, 559-847-0039. We're going to walk through your situation. We're going to get an understanding about what you're trying to accomplish, what concerns you, and we'll just look and see if any of these annuity strategies might make a difference.
559-847-0039. If you are sitting here wondering whether some of these newer strategies, including annuities, actually belong in your plan, actually make sense for you, that is a perfect reason to sit down, talk it through with a professional. Sean is here. He's eager to meet with you. He's eager to see just how he can help. So if you've got $500,000 or more in investable assets, pick up the phone, give us a call right now, 559-847-0039. Like Sean said, the team is standing by right now, ready to take your call and get you scheduled for your retirement planning assessment. Completely complimentary, 559-847-0039, or you can head over to MasonStreetRetirementInsights.com. Now, I've got another study I want to talk with you about, Sean, because one thing that always jumps out at me is how often regret shows up when we talk about retirement. Not always about how much we've saved, but about the decisions that maybe we've made under pressure. So this next study by Nationwide Retirement Institute, it was of recent retirees, and it highlighted a concern we've seen before. About 55% of recent retirees regret how they saved. And that's, not surprising. They wish they'd started sooner and put away more. That's a tale as old as time. But that's not all that this survey found. And we've got Carrie Hannon on Yahoo Finance talking about another interesting find. Let's take a listen.
I think that what happens is, and what this study shows is people who are getting nervous like this, especially these new retirees, they're actually starting to pay attention to their investment portfolios, which is fine on one hand, but they're making changes. And we all know that often might not be your best move, to go shifting things around just when things are a bit rocky.
So I'm wondering, Sean, if you could talk to us about why those pre-retirement years or those early retirement years are the worst possible time for somebody to be making emotional changes to their portfolio.
Yeah, and it seems that it doesn't matter how much money somebody has. We always feel like we didn't do enough, or we wish that we got started earlier. Mm-hmm. It's interesting, the dynamic we go through in the transition between working and retirement. I'm always talking to people about that transition phase is 5 to 10 years, and the earlier that I can get with them, the better off it's going to be. Yeah. But they definitely go through phases. And so one phase is we have gone through and we've saved and we've been disciplined and we've put money into those accounts. And we've grown those assets over time. And now we start to figure out or start to think about that, hey, maybe this retirement is a reality, because maybe I've saved up enough and maybe I will have saved up enough by the time retirement comes. And that allows us to start dreaming. It allows us to start thinking about what we might want to do, what we might want to accomplish, the relationships that we want to affect, the causes that we want to support. And that's exciting times. And then we get closer and closer to retirement, and the reality sets in that, do I have enough money? How do I do it? How does Medicare work? How am I going to determine when I start Social Security? All of these realizations start coming through, and it seems that that's when people really start, if they hadn't already, that's when they really start to get concerned about the management of their assets, especially their 401ks, IRAs, 403bs. We really start to see people try and lean in and take a little bit more of a part. And that can be concerning. Casey, to your question, and Carrie made a good point, that's a critical phase. Events seem to be bigger than ever before at that moment in time. I was talking, Jeff and Sarah came in, I think it was the second week of March. Okay. So just a few weeks ago. We were just a couple weeks into the Iran conflict. And Jeff told me that he hadn't really managed his account. He kind of set it and forgot it for years and years. But then earlier this year, he heard about this Iran conflict and he started to get concerned. And he actually changed his whole portfolio into a bond portfolio. And he did this all because of the Iran conflict. But if the Iran conflict would have happened 4 years ago, he wouldn't even recognize to have made any adjustments. It's all because he's entered that critical phase.
Yeah.
I asked Sarah, I said, Sarah, how do you feel about Jeff making those changes that is going to affect or that could affect your lifestyle in retirement? And then I asked Jeff the same question. I said, Jeff, how do you feel about making those changes? Do you feel like you have the skill set? What was the reasoning behind it? And what I found really interesting is that Jeff, for one, had no way to explain the reasoning for making those adjustments, and Sarah became very uncomfortable.
Ooh. And Sean became a marriage counselor.
Uh-oh, here we go. You know, there is a little bit of that sometimes. But being intentional, having intentional strategy and structure is so important during this critical phase. It's not a time to start making adjustments. Putting a plan in place and staying focused on that plan. Look, if you have the skill set to understand the data, to start making changes based on the current environment, that's okay. But if you don't, it's certainly something you're not going to want to do. Most people aren't successful doing that. If you feel the need for management in that particular situation, get with a consultant, get with somebody that knows what they're doing.
How often do you see people make a move kind of like Jeff did on his own and then come back and say, I wish I hadn't done that? Does that happen often?
You know what? People come in and it depends on what's going on in the environment, right? And it depends where they are in those phases. It's often when people are in that critical phase and I haven't met with them yet. I'm very fortunate that the families that I work for, they don't go make adjustments. They ask me a lot. They ask me about what I feel about what's going on. They ask me if I feel that they are invested properly based on the current environment. But they're asking me and they're getting counsel from somebody who is a professional and knows what they're doing.
Right. Well, take this as your sign to maybe get that conversation started for yourself. 559-847-0039. If you're nearing retirement, maybe you're already there, but you just want a plan that's going to help you stay disciplined when things do get a little rocky. This is exactly why Sean's here, and it all is going to start for you when you pick up the phone. You give us a call today to get set up for your complimentary retirement planning assessment. 559-847-0039. Remember, there's no obligation here either. This is just a discovery conversation and a chance for you to get a better understanding of where you are and where Sean can help you go. So if you have $500,000 or more saved for retirement, the time to call is right now. 559-847-0039 or head online to MasonStreetRetirementInsights.com and click that Contact Us button. All right, on top of all that, Sean, then you add one more layer, the headlines and what they are all telling us is going to happen, and things can get really crazy. I mean, if you pay attention long enough, you're going to hear every possible prediction. We've got boom, bust, crisis, catastrophe. For instance, the author Robert Kiyosaki, he wrote the book Rich Dad, Poor Dad. He recently warned that baby boomers could end up homeless or living in RVs because Social Security and Medicare are broke, which we know is not true. So I wanted to look at a few other bold predictions that have happened over the year. And I found that Warren Buffett said in 2023 that an incredible period of economic prosperity would be over by the end of the year. Gloom and doom economist Harry Dent, he predicted a major market crash in 2023 and claimed NVIDIA would fall 90 to 98%. Market was up about 20% that year. And if we go all the way back to 2004, a writer trashed a new stock offering saying the company would not maintain market share. And that IPO was Google. So my point to all this being, Sean, is that I'm curious how you help your clients tune out all the noise that we're talking about and really stay focused when scary headlines like this start flying around. What's your approach? What are your conversations like with your clients when they get a little squirrely?
Yeah, I'll tell you, headlines, media, all the noise, it's the biggest adversary for a investor, especially somebody going into retirement. It's probably the biggest cause by far more than any market correction of retirement defeat. At minimum, reduction of retirement lifestyle. Look, it's because, fear sells, right? Mm-hmm. They're not going to talk about the greatness because people don't tune in to hear the good. People tune in to hear the bad. When you hear people like Harry Dent who are talking doom and gloom, eventually they're going to be right. Somebody predicted the 2008 fallout, but they had been predicting that for 20 years. Mm-hmm. The problem is nobody has the crystal ball. Nobody knows the timing. You have to be able to look at the data. You have to understand what the economic environment is. Everybody was going to talk about a certain event. Last April in 2025, it was Liberation Day when Trump put the tariffs in force. Everybody thought the sky was falling. Look what happened. Market goes down 4% and ends up 17% ahead for the year. Mm-hmm. Look, these people are always going to be trying to sell their story. They're always trying to be out for clickbait. It's just something that you cannot tune into. It's never the market that's the problem. It's always the lack of preparedness and then the emotional reaction that creates the problem. Mm-hmm. We want to be proactive. We want to have structure. We want to have strategy in place. If you do that, then you're always going to be good during the good and bad. It's always about being prepared and proactive and never emotionally reactive. Mm-hmm. I was talking to Bonnie, a few weeks ago, and she was telling me how her mother last year, and I brought up Liberation Day on purpose because Bonnie was telling me how her mother had been hearing the headlines, had been hearing about how tariffs were going to just destroy the economy. And so she got completely out of the market. She actually went into short-term treasury bonds. She was right for about the first 2 weeks. The problem is she felt, and she was on the wrong side of politics, she felt that because Trump was in office and all the headlines that have been out there, that Trump was going to ruin the economy, and she really missed out. She missed out on a lot of growth. Mm-hmm. And that was all due to headlines and the media attention that she was listening to.
So the danger is not really in the headline itself. The danger is in how we react to it, right?
It's really well put, isn't it? It's never about the headline because there's always headlines like you just look, I'm not going to put Warren Buffett in that category. He made a prediction, but I don't believe Warren Buffett is out there trying to stir the pot.
Right.
He probably truly believed that, but there's a lot of, pundits, journal writers, report writers. They're trying to stir the pot. They're trying to get you to look at their stuff and hopefully sign up as a member. And they're going to put you in a position of fear because they're going to try and convince you that they have the solution. And they never have the solution when they're coming from a position of fear.
Well, and I had to do a little digging to find some of these predictions that never came true. So why do you think we don't hear as much about predictions that never end up coming to fruition?
Yeah, why do we never hear about these people that made the prediction last year and that were wrong, right? It's a good question. I do not know the answer to that.
Well, what is it about these scary headlines that make them feel more believable to us than the good news? It's even, when you watch the nightly news, it's all the doom and gloom first, and then at the very last minute, it's like, and in good news tonight, and there's one story.
And that's when we get up to...
That's when you go make dinner.
Yeah. Yep. That's for sure. I don't know the answer to that. What is it about psychology that drives us to listen to the negative? Mm-hmm. We get this fear and then we want the solution. We don't need a solution to anything that's positive, right? This is why it's so important to have somebody in your corner. It's good to have a professional in your corner that can help talk through the emotions because the emotions are your biggest adversary. And so I really encourage you to come in and have a discussion with us. For our first 5 callers, we're going to create your very own comprehensive retirement planning assessment. We're going to talk about all of those elements that you need to be identifying for retirement: taxes, investments, estate planning. We're going to give you the opportunity to get a better insight in what your situation is. So give us a call, 559-847-0039. Our team is standing by. and they'll help you find a good time on the calendar.
559-847-0039. Headlines are always going to come and go, but a solid plan and a trusted partner to walk with you on your journey is what's going to keep you grounded. So if you have $500,000 or more saved for retirement and you're ready to get the conversation about your financial future started, 559-847-0039 is what you need to pick up the phone and dial right now. That's going to connect you with one of our Mason Street teammates who are standing by right now. They're ready to take your call, and then they will help you find that next convenient time on the calendar to talk directly with Sean. And remember, this can be on the phone or in person or on Zoom to start you out, whatever you're comfortable with. But this is just a discovery conversation all about you, all about your specific situation so that Sean can assess just how he can help you move forward on your retirement journey. Our space is limited, though, so the time to act is right now, 559-847-0039, or find us online. We are at masonstreetretirementinsights.com. Earlier this week, a friend of mine sent me an Instagram post that talked about various fears or phobias. One of them was called Plutophobia, which is the fear of money. So, of course, I went down the rabbit hole and I read that this can manifest during retirement in the fear of spending your savings. And what's one way to overcome that? Well, this article talked about one tool that helps increase certainty. So, what do you think they're talking about here, Sean?
Well, and it's a real thing, Plutophobia. We don't run into it often because people that suffer from it typically have trouble accumulating wealth throughout their life. But it has come up a few times with people, especially who had recently inherited significant amounts of money. But that fear of running out plagues so many of us, maybe not to the level of Plutophobia, but it certainly interferes with lifestyle and quality of life. And often this affects a spouse who wants to live their greatest life, but are being held back by their spouse's concerns of running out of money and not having enough. The good news is there's a fix. You've heard me say so many times, going through our comprehensive planning process, it helps people see the reality of their situation, and then it exposes them to income strategies that can completely remove those fears and concerns of running out early. It really boils down to the income strategy that'll be the best fit. We've been told for years that we're financially prudent if we take 4% a year out of our accounts that are invested in the market and that will never run out of money. There's a lot of risk. That may or may not work. You're hoping the market performs to suit that strategy. It relies heavily on what's called sequence of returns, hoping the market delivers positive returns in the earlier years of retirement. Most of us want more certainty that our money will last. And there are income structures guaranteed and insured by A-rated insurance companies with multiple layers of protections. So some families might want to guarantee income to maybe cover their core expenses and then rely on the market for lifestyle desires. Some want to guarantee both and then use the market to grow the rest of their money long-term for healthcare expenses and eventually legacy. I've found that when families have the right balance between guarantees and taking risk in the market, they feel more secure to spend and live that lifestyle that we're hoping for. We can design and tailor an income plan to suit a family's needs and lifestyle desires. Risk tolerance, flexibility, short-term versus long-term spending, taxation, these are all aspects we need to consider in that income plan design.
Yeah, I mean, it's always inspiring to me to hear how someone finds that confidence to enjoy their retirement that they've worked so hard for. And sometimes it really just takes that one moment or that one strategy to help them break through those worries. So have you ever seen a client make that leap, Sean, moving past the fear of spending in retirement and what, made the difference for them?
Yeah, Casey, that aspect you bring up of fear of spending, it's just no way to live your best life. And we deserve to have both lifestyle and security. And we can. Jared came into our office He wanted to come in separate from his wife, Carrie, for the first visit. We don't usually do that, but he really talked about the need. And he explained that Carrie was having a hard time being confident that they could buy the cabin at the lake, which they had dreamed of for years, but then still continue that same lifestyle they were accustomed to. And they had some bucket list items that were really important to both of them. When Carrie came into the next meeting, I asked her to tell me what was important to her. Through that discussion, we identified that the issue was having to rely on the market. She said they lost over 30% of their savings in 2008, and she just knew that could happen again. So we created a net worth and cash flow analysis based on their current situation, and we tested how they would be affected in the event of a severe market correction. And I'll tell you, she was right. It would significantly alter their lifestyle and put them in jeopardy of funding future healthcare needs. So using specific investment and tax strategies, we were able to design an income plan that guaranteed the income they would need to cover the cabin expenses. It gave them the money they would need to check off those bucket list items over the next 10 years of retirement, and then ensure they would continue the same lifestyle they were accustomed to. They were both comfortable with relying on the market to fund those long-term expenses like long-term health care, and they figured the cabin would be the safety net in case they lived longer than they planned for, or be the legacy to the kids along with their residents. You know, Jared just emailed me letting me know they found the perfect cabin and put an offer in. I got to tell you, Casey, it's just so fun to see them so excited.
Oh, that's amazing. You love to hear it. I mean, that fear, it's true. It can keep you from enjoying the very retirement that you worked decades to build. And that's exactly what we do not want to happen. So if you're wondering whether you're being too conservative with your spending, or if you just want to know what is safe to spend without jeopardizing your future, Sean is here. He is eager to help. So give us a call. 559-847-0039 is that number for you. Claim a spot on Sean's calendar. Get that complimentary introductory retirement planning assessment that he's offering you. You guys can walk through your income sources. You can walk through what your goals are. And then together you can work to build a plan that's going to work for you and give you that confidence that you've been looking for. Our number for you again, 559-847-0039. One more time so you can write it down, 559-847-0039. Or you can always visit us online. We are at MasonStreetRetirementInsights.com. We'll give you a few minutes now to make that call while we take a quick break, but don't go anywhere. Lots more is still ahead here on Mason Street Retirement Insights. We'll be right back.
There are many lessons we learn as we're growing up. One was, don't touch the hot stove. Ow. Today, Uncle Sam is trying to keep that lesson alive with your 401k. Think about it. Don't touch your 401k before 59 and a half. You'll pay a penalty. Hot stove. Oof. Or don't touch your 401k. You'll have to pay taxes. You'll get burned. Ouch. You've been saving in this account your whole life. Why shouldn't you use it for retirement? So the financial industry can keep charging you fees or the government can roll up your tax bill? Come on. Sean Mason at Mason Street Wealth Management believes in letting you enjoy your money. You worked for it, you saved it. Let's give you the confidence and permission to spend it. And there are plenty of options for you to explore. Go to MasonStreetWealthManagement.com to find out more. It's a no-obligation meeting to talk about planning and enjoying your retirement. Or call 559-847-0039. That's 559-847-0039. And let's give you some financial oven mitts for your 401k.
You have found Mason Street Retirement Insights. My name is Casey, and I am here with my buddy Sean Mason, president of Mason Street Wealth Management right here in Fresno, asking for his ideas on things that you can be working on as you get closer to your retirement. As you are listening today and you've got questions, want to remind you of our phone number. That's 559-847-0039. You can schedule some time to sit down with Sean for that introductory retirement planning assessment. 559-847-0039. Or we are also online. That website's MasonStreetRetirementInsights.com. All right, Sean, one of those things that people hear about all the time, but they don't always do. And that's a tool that we call rebalancing. But what exactly does it mean for your retirement portfolio? Well, we've got Morningstar's Amy Arnott talking about this. Let's take a listen.
Rebalancing usually will involve selling assets that have gone up because they would be over your target levels and using those proceeds to buy into asset classes that have gone down. And why that can be difficult is sometimes if things are going up, people are reluctant to sell. And in fact, you could miss out on some gains if you sell for rebalancing purposes. So the purpose of rebalancing isn't necessarily to improve your returns, but really to control the risk level of your portfolio so that it doesn't drift too far away from your target levels.
But it's estimated that about 30% of those nearing retirement, that's in that 55 to 64 age range, they never rebalance their 401ks and their IRAs. So I'm wondering, Sean, what problems can happen? Can you talk to us about your thoughts around rebalancing?
Yeah, Casey, it's a really good topic that you bring up because it just doesn't get the attention that it deserves. And it's a really important piece of the investment process. As Amy was pointing out, you really got to make sure that you are staying within the confines of that target allocation. And as she pointed out again, it's really about the risk. It's not necessarily about the rate of return. So rebalancing happens on multiple levels. You can have a mutual fund manager. You can have an exchange-traded fund manager, and they have a group of stocks or a group of bonds or a combination of, and they want to make sure that each one of those holdings has the right weight. And so sometimes they have one stock that's outperformed another, so they've got to sell some of that and buy some that has underperformed to keep the integrity of that target allocation. So you've got the fund manager rebalancing, and then you might have a model manager, a money manager that you're working with to have a certain model in your portfolio. Maybe you have a Vanguard target date 2040 fund. And within that model, there are 5 or 6 different exchange traded funds. And now that model manager has to again rebalance to make sure that there's the right amount of weight in each one of those funds. So there's another level of rebalancing. And then you might get somebody like me that in your portfolio, I'm utilizing 4, 5, 6 different models. And so now I am rebalancing each model to make sure that there's the right amount of weight in each one of those models. So now you just had 3 levels, one on the fund level, one on the model level, and now one on the strategy level. Mm-hmm. So really important to get that right. There's a lot to consider when you're rebalancing because rebalancing can create taxes. It can interrupt rate of return. We've got to get back to that risk profile to ensure that in a circumstance of a downturn in the markets that you are taking the right exposure there. And so management of each one of those considerations is really important.
Well, let me ask you this, Sean. If we're talking about somebody who's within, let's say, 5 to 10 years of retirement, how quickly can this get out of hand if it's something that's ignored, if it's something that's not, talked about and addressed heading into retirement?
Oh, it can get out of control and very quickly. You might watch this out of balance happen over the course of 6 months to a year. If you've got technology in your portfolio, in your account, technology is crazy right now, and it's really, there's growth stocks that are outperforming by 10, 15, 20% sometimes another growth stock so quickly. And so this is why I really want to encourage you all to come in and have a discussion with us in the office. We're going to walk through, and I really want to encourage you to come into the office. If you're wondering about whether or not you're invested properly, if you're wondering about allocations in your portfolio, let's take a look at that. And Casey, I think this time for our first 5 callers, we're going to go ahead and include our portfolio X-ray.
Okay.
This is where we can dive deep into the holdings. We can get an understanding about what type of risk is in there, what the rate of return projections are. We can take a look at this rebalancing concept that we've been talking about today so that you get an understanding how that looks and how that works within your own portfolio.
You're going to want to take advantage of this deal. 559-847-0039 is that phone number to do it. If you're sitting here thinking, I honestly have no idea if my portfolio is properly aligned for retirement. That is a perfect reason to start the conversation with Sean. So give us a call right now, 559-847-0039. That's how you'll get connected. Or, of course, you can also visit us online at masonstreetretirementinsights.com and click contact. So we're talking about rebalancing, Sean, and why ignoring it can create problems as you get closer and closer to retirement. And that actually leads me to something else that I want to talk with you about today, because even when people think they're being careful, new risks can find their way into retirement plans without much warning. And we're starting to hear more about 401k plans potentially adding things like Bitcoin, private equity, even access to IPOs. Regulators and plan providers are actively exploring these options, but they come with higher risk, they come with higher fees, and less transparency than what most people are used to in your typical 401k. So, Sean, I'm curious your thoughts on this, especially for somebody in their 60s who's nearing or maybe even already in retirement. How should they be thinking about these newer investment choices? What do you think? What are your thoughts?
Yeah, and we look at these as kind of the alternative asset classes or alternative investments. You know, the investment world, it's like technology. It's constantly evolving. It's constantly improving. And a lot of it's good. A lot of it's really good. And then some of it's not so good. So some of these new investment techniques, they really have a position in a portfolio to do some good things. But a lot of it could be smoke and mirrors. So it's really important to understand what's going on in there. There's a lot of these different strategies that are just destined to fail just because the inherent characteristics. Mm-hmm. You know, with any investment, you've got to make sure that you understand it. If you are choosing your own investment allocations, you got to understand fundamentals and understand what's really going on in those alternatives. And when I talk about understanding, you know, there's certain levels of understanding. Those of us that invest in Microsoft, we don't necessarily go in and look at the financials of Microsoft and understand every intricacy in that company. But there's a lot of credibility behind that company. There's a lot of discussion. There's a lot of information available. And so we rely on that information. If we are comparing investing in Microsoft to a startup company, you don't have that credibility. You don't have that history. And so you really want to dive in and understand what's going on with inside of that company before you invest in it. And the same thing is going on with these alternative investments. What makes it difficult is sometimes there's just not a lot of transparency. Often there's very little history. So you really got to go get in and apply fundamentals. You got to stay out of the hype and the headlines and make sure that you understand what you're investing in. You know, keep in mind that we've always got to know what the purpose of the investment is. We've got to understand what we're trying to accomplish. Mm-hmm. And every investment is going to have a trade-off. And we got to know what those trade-offs are and make sure that it's worth it. Can we still reach the goal and what we're trying to accomplish, even with the trade-offs that are inherent within that investment? Make sure that it fits within your plan. And that's why we're always preaching. You know, that planning element is so important so that we understand what we're trying to use a particular investment for. Mm-hmm. And especially with these alternative investments, there's a lot of considerations. You know, you got to consider risk. Often they're highly inflated with fees. Be very careful with liquidity because very often there's a lack of liquidity, meaning you're committing to several years within that investment. Mm-hmm. You also got to know regulation. How is a certain one of these funds or investment strategies regulated? And then how are taxes going to be affected? How is your tax liability going to be affected by utilizing one of these strategies? You know, being intentional about the positioning is really important. Think of it like maybe you're building a house and you've got to have that core foundational structure. And in that portfolio, it's the same. You've got to have those core traditional strategies, but maybe you can utilize some design features to enhance the house, and the same with the portfolio, enhance the portfolio with the alternatives, but you still got your strong foundation.
Well, I want to ask you this, Sean, because I feel like some people will hear about these new kinds of options inside their 401k, and they just assume, you know, well, it must be safe because it's allowed. But don't you think that's a dangerous assumption?
Yes, it's a really good point that you bring up because you never want to rely on regulation.
Yeah.
Regulation is not going to be there to back you up if things go south. That is for sure. We've seen this time and time again. It ends up in court litigation. Attorneys are who make all the money, and the investors typically are the ones that miss out.
If you had somebody new come and see you, they're in their 60s, and they don't have decades to recover from a mistake. They're retiring in the next 5-ish years. What's your biggest concern that you'd have if you saw things like crypto or private investments showing up in their retirement accounts if they're that close on the brink of retirement?
Yeah, I got to make sure that that investor or that family that I'm talking to understands why they're there, understands why those holdings are in the portfolio in the first place. Maybe they didn't even realize it was in the portfolio. Maybe they didn't understand the consequences of what could happen. And so just a clear understanding of why they're using those particular investments, what they're trying to accomplish, and did they know the consequences if things don't work out well for them.
Well, so timing does really matter here, because if you've got someone at 35 talking about this in their 401k and someone at 65, they really should not be thinking or taking risk in the same way, right? Timing is a huge factor when it comes to this.
Yeah, it really is. And even though somebody is close to retirement, we can still recognize that there's a portion of the portfolio that is probably not going to be spent or used for 10, 15, 20 years. So there might be a position for some of these riskier asset classes that they may need to have a little bit more time, like a 35 or 40-year-old would have. And so that's okay. It's just about proper positioning and ensuring that they understand the consequences.
Do you think sometimes people are chasing these types of investments because they've got FOMO, they've got that fear of missing out, even when the missing out might actually be the better, safer move for them?
Yeah, the hype gets to people. You said it. It's the FOMO, the fear of missing out.
Yeah.
But, once you really dive in and help them understand what those consequences are, what could happen, it seems like that the FOMO seems to subside a little bit.
Yeah.
And that hype dwindles.
And so I'm guessing, though, that you've then seen cases where people took on more complexity than they needed. Maybe it was because they feared missing out when simplicity would have actually served them better. And how do you talk them through that? How do those conversations go when you spot something that's not in their best interest?
Always understanding the perspective of when the money is going to get used. It's all about the timing of when the money in the portfolio is going to get used. It's the time horizon of each dollar that's most important. So then when you're looking at different types of investments for each dollar and you're considering what those horizons are, very often they're going to start recognizing what is right for them. It's just they needed the information. They needed the understanding of how those different types of investments perform, what the consistency is, how long they should expect to keep an asset class like that.
So is this something that you talk about with people in that introductory retirement planning assessment? I know today you're also offering the Portfolio X-ray on top of that. So is this something that you can take a look at for them if they give us a call and get set up today? Is this something that you guys can dive into in that conversation?
Yeah, I for sure. I want them to understand everything about what they're invested in. So important. I can't suggest that anybody invest into any type of a fund investment strategy without me completely understanding it. And I believe that when people understand the intricacies of each investment, they're going to know what they want for themselves. It's not about me having to tell somebody what they should be invested in. It's about me having to explain what the options are, maybe with some recommendations on the direction that they should go, but they're going to know what they want once they get the information.
If you'd like to get set up for your very own introductory retirement planning assessment and Portfolio X-ray with Sean, 559-847-0039 is the number to dial. If you're sitting here hearing about these options inside your 401k and you're wondering, does this make sense for me? That is a great reason to give us a call and sit down and talk it through with a professional. 559-847-0039. When you dial that number, that'll connect you with one of our Mason Street teammates who will then help you get scheduled for that next convenient time on the calendar to talk directly with Sean. I promise you do not want to miss out on this opportunity, but our space is limited. So we want you to go ahead, dial right now, 559-847-0039, or head online to MasonStreetRetirementInsights.com and click on that contact tab. Now, before we go today, Sean, it is Mother's Day weekend. So I heard this clip from Jeff Foxworthy this week, and I knew I wanted to play it on our show today. Jeff Foxworthy did not grow up dreaming of being a comedian. He actually was just kind of the funny guy at work, and his friends really pushed him to enter into this local stand-up contest. This was back in the 1980s, but I've got a clip from him I want us to listen to.
I was scared to death, had no idea what I was doing, but I knew a minute and a half into it, I'm like, this is what I was born to do. And I quit my job. And my mother's first question was, are you on the dope? I don't know what the dope is. And I'm like, no, I'm not on the dope. I said, Mom, I think I can do this. But 5 years later, I'm on Johnny Carson. That same mother said to me, you know, you wasted all those years at IBM.
It's so funny. But kind of the moral of the story, Sean, is that families don't fear the dream. His mom didn't fear his dream. She just kind of feared the unknown. So I'm curious, when you've got a client's family and they're skeptical about how their loved one's retirement is going to go if they're ready, how do you walk the whole family through this so that it does not feel like a leap of faith? How do those conversations go when it's more than just the retiree sitting in front of you? It's the whole family.
Yeah, it's a really good question. It's an interesting dynamic, but, you know, Jeff Foxworthy has been so much fun over the years. You know, he did a tour with, back in the day, Larry the Cable Guy.
No, of
Remember
course.
Get Her Done?
Oh, yeah.
Yep, and Ron White with the Scotch and cigar routine. Those were good days. And, you know, it was kind of fun with those guys because you could actually have the whole family listen to it. It didn't get too X-rated, and they still found a way to be
Clean comedy and
hilarious.
Still made you laugh.
Yeah,
That's a special
pretty
skill.
rare.
Yeah, I agree.
Isn't it?
I agree.
There's definitely a skill set there. But you're right, the family dynamic, it's so interesting, and at the same time, it's so important. I really try and help people when they come into the office and we're having the discussion that every decision that they're making is not only affecting them, but it's affecting their family, and not always have they thought about that. It can affect quality of life of them, but also their family members, whether it's their parents or whether it's their kids. And I find that the older that the couple is, you know, the younger couples, typically the kids aren't as involved. But usually it's the spouse that we really have to focus in on, because often one of them has been kind of saddled with taking care of all the finances, and the other one doesn't always have a clear understanding of what's going on. They just kind of
taken a back seat all through the years.
They have, and they've just kind of trusted, right?
Yeah, it's dangerous, though.
And so it's really important that they get a clear understanding of what's going on. I've got to actually hear from them. I've got to understand what they're concerned about, what's important to them, what they would like to accomplish. It's not just about investing. And so getting that kind of clarity from the spouse is so important, and then them becoming aware that, look, if something happens to your spouse, you're going to have to step in.
Right.
So the more you know now, the better off that you're going to be.
Yeah.
And then as the couple gets older, I find that, and their kids actually get older, I find that they kind of start trying to step in a little bit, kind of start wanting to get a better vision of what's going on. They recognize that maybe they're going to have to step in and help, either if it's just physically or hopefully not, but they might be concerned that they'd have to step in and help financially.
Yeah.
And so I'm always making sure that the families that we work for understand that we're working for the family. It's not just the parents. And I always encourage them to bring their kids in.
Yeah.
And I have to be careful about privacy, of course, but I want to make sure that their kids are invited. In fact, we go so far as letting them know that we will create planning for the kids as well. The reason for that I find that the better off their kids are, the better lifestyle they're going to have, the parents are going to have. But also, when you take the kids through a planning process, they understand now better what's going on with their parents. And so it's a really good experience for them.
I think it's so important for the kids to be involved. We lost my dad really suddenly, and he was the money man. And, my mom was in the know. She's very, very smart, very educated, but he really kind of steered the ship. And so you better believe I've been in every single meeting with her when she's, trying to get a grasp and take over and figure out what she has to do. I've been right there beside her because, too, we need to know what's going on. Should something, God forbid, happen to her, we need to know what's going on. So I think it's so important to be part. And then on the inverse, we lost my husband's dad and there were no conversations, and we're in a real mess there where we could have totally benefited from sitting down, having these conversations. So kind of seeing both sides. And I'm like, we have the opportunity to be prepared and plan and take the right road on this side. We need to be involved as much as we possibly can. But a lot of parents do. It's the privacy thing that you were talking about. A lot of parents get kind of weird bringing in the kids, but I think it's so important. You got to kind of drop that sheet and allow the transparency to come through when you're getting close to retirement and these conversations start happening.
Yeah, I think you're right. And hey, how great is that for your mom to have you?
She's so
you've
lucky.
Got a lot of know-how, right?
I was like, hey, what time's the appointment? I'll be there. I'll be there early with bells on. But it honestly made her a lot more comfortable, I think, to have me there and my brother involved as well, because it's a lot to take on. It's a lot for her to get a hold of and get a grasp on. And you're sitting across from perfect strangers who, you're talking about your life savings with. And it can be daunting and it can be intimidating. So I think for a lot of people, having the family there can kind of ease the intimidation factor as well. So it's been great.
Yeah, that's really good. And I get it. And I see that as well. You're right. In the beginning, it's the privacy factor. But as we get going and we start talking about things, I don't have to get too in detail about everything. Mm-hmm. I just have to give the kids a fundamental understanding of what's going on. And they want to know that everything's going to be okay. And so, with that, Casey, I really want to encourage our listeners. I want to encourage you all to come in and have a discussion and, bring the family, bring the kids. We're so happy to have everybody come in and participate in that discussion. We'll walk through your situation. If you want the kids there, they have the opportunity to ask questions. And we're actually going to provide you with your own individual comprehensive financial planning assessment. We're going to take into consideration and discuss taxes, rates of return, risk factors in your portfolio. We're going to include that portfolio x-ray on this one. So give our team a call, and they're standing by. They're standing by right now, and they're going to find a good time for you to come in.
They are ready to take your call. 559-847-0039. I think this conversation is a great reminder that retirement should not feel like a leap of faith. It should feel thoughtful. It should feel intentional, and it should be shared by the people who matter the most to you. So if your family has questions about your retirement, let Sean help you turn the unknown into a plan that you can feel good about, that you can feel confident about. 559-847-0039 is how you reach us to claim your spot for your very own complimentary introductory retirement planning assessment and portfolio x-ray. I promise you don't want to miss out on this opportunity, but Sean's space is limited, so the time to call is right now, 559-847-0039, or you can always find us online as well. We are at Mason Street, retirementinsights.com. You'll click on that Contact Us button at the top, fill out your information, make sure you say you heard us here on the radio, and then we'll have a Mason Street teammate reach out directly to you. But the quickest, easiest way is just to call right now, and we'll get you scheduled. 559-847-0039. That's going to do it for us this week, but we will be back next week, same time, same place, with more retirement insight for Fresno. But until then, Sean, I'm going to hand it back over to you to take us out today.
That was fun, Casey. I just want to encourage everybody, keep coming back. We care about your success in retirement. We want it to be great. We're going to keep bringing you information to help you put yourself in a better position. So we'll see you next week.
Mason Street Wealth Management, MSWM, is a registered investment advisor, and the opinions expressed by MSWM on this show are their own and do not reflect the opinions of Motivate Investments. Registration is not an endorsement by securities regulators. Investment advisory services are offered through Motivate Investments, an SEC-registered investment advisory firm. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. By contacting us, you may be provided with information about insurance products, including annuities. Offered through Sean A. Mason, California, insurance license number 0B54860. The firms are separate entities. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company and are not offered by Motivate Investments. Read your contract for restrictions, limitations, or penalties. MSWM is not licensed in all 50 states. To find out if MSWM is licensed in your state, please call 559-892-0002.